A Year for Accumulation with Monex, featuring Managing Partner of CPM Group and author of the Monex Precious Metals Market Outlook Report, Jeffrey Christian.
Hello, my name is Sean Brasney, Sales Director for Monex Deposit Company. I'm here with Jeffrey Christian, a Managing Partner and founder of CPM Group and the author of our Year for Accumulation report. Thank you for being with us today, Jeffrey.
It's good to be with you.
Our theme this year has been the Year for Accumulation, but as we come to the end of the year, the strategy for accumulating precious metals hopefully will not end as investors continue to build a core position in the metals. And many financial talking heads in the market will tell you that it's smart to have anywhere from 5 to 15% of your net worth in gold. I know CPM Group did a long-term study and has some good data on this. We shared it at the beginning of the year, but would you be willing to review that again for us now?
Sure. What we did is it's called an efficient horizon, and you start with a portfolio that's 50% S&P and 50% T-bills or T-bonds. And then you say, now what happens to my risk-reward ratio and of that portfolio if I add 5% or 10% or 15%? This was originally done in the early 80s by Ibbotson Associates in Chicago, and they saw that 5 or 10% of your portfolio ought to have been in gold. And that number stuck in the market ever since that time. Around 2016, 17, 18, CPM Group updated Ibbotson's data going from 1968 to 2016, 2017, instead of 1968 to 1980, the way they had done in the early 80s. What we found was that over that longer period of time, 68 to 2018, the optimal amount of gold in terms of the risk-reward profile was actually closer to 25 or 30%. So that at 25 or 30% of your portfolio in gold over the last 50 years, you would have had the least amount of risk for the most amount of reward proportionately at that point. So it was much higher than anybody had thought about, and no one had bothered to update the research for 40 years.
Now, I was reading a report from you from last year, just perusing through some of my information, and you made a statement that really kind of stuck out for me. I think it's fairly a simple statement, but for me, it's somewhat profound, and that gold is fungible. Would you explain why that's so important?
Yeah, it is important, and it goes to the heart of the whole issue of a year for accumulation. You want to own gold because you're looking for capital appreciation, but you also want to own it as an insurance policy against personal catastrophes, and an insurance policy against national, regional, and global catastrophes. When you get into a period of, say, rising inflation, what you'll find is that gold, which is fungible, an ounce of gold is an ounce of gold. You can argue about the purity, but you know that if it's impure and needs to be upgraded, it's going to cost you $2 an ounce or maybe $3 an ounce, as opposed to diamonds, which are not fungible. The value of a diamond is determined by a grader, an individual who's an expert who looks at it and says, this is a $10,000 diamond, or this is a $1,000 diamond. Now, if you look at gold and diamonds during periods of, say, inflation or economic unrest, what you'll find is that they're both tangible assets and they both rise in value. But if you look at gold and diamonds or colored gemstones or works of art or other non-fungible tangible assets, if you look at those in periods of catastrophic unrest, say world wars, or a war in your area, then all of a sudden gold rises in value and the non-fungible tangible assets fall in value. If you're in a place that's a war zone and you need to buy your way out of there and you have an ounce of gold, the guy might say, well, this is not good delivery gold. And you say, fine, knock $2 off the price and give me my money so I can buy a plane ticket out of here. If you've got a diamond and he knows that you need money for a plane ticket, it's going to be a $1,000 diamond, not a $10,000 diamond. So that's one of the key elements of fungibility that applies to gold and silver and it doesn't apply to other tangible assets.
Talk to investors, and many of them are a little worried about a global slowdown, and they're worried about how that might impact the industrial metals like silver. But I read that CPM put out a intermediate buy recommendation for silver, and of course that's over a 2 or 3 year time frame. But you also cited some compelling supply-demand fundamentals in that report. Would you be willing to share some of that data with us?
Yeah, well, first off, the key is it's an economic slowdown. It's not a recession. And it's an uneven economic slowdown. So you are seeing weakness in Chinese car sales. You're now seeing weakness in U.S. auto sales. But basically, most economic activities have been expanding. They've just been expanding at a much slower rate this year than late last year or in earlier times. So you're still seeing demand. Now, with silver specifically, one of the big growth areas economically on a worldwide basis is solar panels, and they're using silver. They can cut down on the amount of silver. They're looking for substitutes for silver in solar panels. But right now, solar panels have been an enormous growth market for silver use over the last 10 years, and that's probably going to accelerate. I believe the International Energy Agency said that the amount of solar panels to be installed in the coming 10, 20 years is roughly, on a global basis, is roughly equivalent to the total electricity generating capacity in the United States right now. So that's an enormous market in solar panels, and they use silver, and they're going to continue to use silver. There's a host of other electronic applications that are also growing that use silver. And silver, because it's much cheaper than platinum or palladium or gold, tends to be the metal that you substitute into when precious metals prices are rising. So you have a relatively strong fabrication demand. Yeah, it's weaker than it was, but it's still growing. Total supply is relatively flat, and we expect it to fall over the next few years. You have, before you get there, a very tight market right now. The market, total supply from mine production and secondary recovery hardly meets fabrication demand, let alone has surplus left over for investors. Investors have not been buying a lot of physical silver last year and this year, but they will. And our expectation is that investors will come back into the market looking for physical silver, partly because they're concerned about economic and political developments in their home area, or their home country, or their home region. And when they do, that's a very tight market already. So our expectation is that you've got a relatively tight market based on the fundamentals of total supply relative to fabrication demand. And then if you see a rejuvenation of investment demand, you're likely to see a pretty big price response to that increase in investment demand.
Well, Jeffrey, your information and data is always extremely important and valuable to us. We really appreciate your time today. Call Monex today. Talk to our account representatives and ask for your free Year for Accumulation report.